Good afternoon, everyone, and welcome to this webinar with James Uphaugh, Manager of the Edinburgh Investment Trust. James took over Edinburgh a little over 3 years ago in March 2020 and has delivered strong outperformance of the benchmark since. Edinburgh sits in the UK equity income sector and the shares trade on a discount of around 8% with a historic yield of a little under 4%. Before I hand over to James, this probably isn't your first webinar with us, but just in case it is, we have around 30 minutes for the presentation and 15 minutes reserved for questions. And if you would like to ask a question, please do so on the right of your screen, and I will put those questions to James at the end. So with that, I will hand over to James.
Thanks, Thomas. So the subject is the Edinburgh Investment Trust, and it's a great time to be talking about this because we are over 3 years into managing this prestigious mandate, the Lion Trust Global Fundamental Team. Now, we were appointed after a rigorous due diligence process on a number of facets, and I'll just draw a few of these out before cutting to the chase, which is obviously the numbers. So, I think what really attracted the board to the Global Fundamental Team at Lion Trust was this flexible style, the idea that really what we were looking to do through fundamental analysis was curate, if you like, a 40 to 50 stock portfolio, drawing on a number of themes, which I'll make clear later in the presentation, number of styles, so both growth and value, and obviously endeavoring to outperform in the net asset value relative to the all-share index, and obviously aspiring to grow the dividend in excess of UK inflation, which was a slightly tougher yardstick over this recent past. And allied to that, we have obviously strong colleague engagement and risk management. So if I cut to the chase and look to this first proof point, this is obviously a critical slide for any fund management process. And if I draw your eyes to the right-hand side of that slide, you can see that the level of performance relative to the all-share is strong, both at that net asset value level and also obviously at the share price level, as the discount moved in from frankly, a slightly uncomfortable level of sort of low teens to its current level of high single digit, with obviously work to do there. And obviously, for those of you who love their investment like me, you'll be aware that this period had numerous different chapters during COVID, and then obviously we've seen us move out of hibernation and move back to a sense of a new normal. So 3-year proof point, I would say, tick in the box. In terms of attribution, a slightly gritty slide here, but really what I'd like you to take away from this is, if you like, if you look at the drivers of that, there's not particularly anything hugely outsized, which speaks to the strength of our fundamental analysis. I think what it also speaks to is portfolio construction, because remember, we are endeavoring to get this trust to outperform over 3-year periods, and also risk control. So that visually, I think, helps in terms of that. Obviously, when we come to questions, happy very much to ask any questions on any of the individual ones which piques any of the listeners' interest. Now, this is a sort of, if you like, a sort of summary slide, and it's really trying to sort of emphasize, I think, that really it's a peach of a time to be talking about UK equities in reality, because there are a number of stars aligning. We're all aware that actually, post the 2016 Brexit vote, there was a huge degree of uncertainty, both political and I think in terms of our relative economic growth rate as a nation. We were candidly and measurably in the slow lane. And I think this obviously coincided with pension schemes de-risking, wealth managers moving more and more in line with the MSCI index, which obviously has a much bigger weighting in the US. And so the net result, culminating obviously events in last year with the political shenanigans in the autumn of last year, the net result is, in valuation terms, we are actually at a very, very low ebb. And obviously, the last decade, people have put valuation to one side, but I'm a big, big believer that valuation in the end matters. And the joy of this is we're investing in the UK equity market where valuation is low. And in an investment trust such as Edinburgh, you're also getting low valuation at a discount. So I personally think of that as a double discount, if you like. And obviously what we're looking to do is outperform the all-share in a responsible way. Now, if I give you a sense, if you like, of our investment process. In terms of how we do it, the team is nicely formed. We draw on expertise in the UK and my colleagues in the global side. And really what we're looking to do is spend about a quarter of our time looking at the macro, reading the runes, and really trying to think about the positive tailwinds that, if you like, we can hitch our wagon to, and trying to avoid the building headwinds. And what's interesting at the moment is I would say the headwinds are more the other side of the pond in the US, and we can expand on that if you want in questions. But actually in the UK, a lot improving, albeit from a low ebb. And markets, as you know, are about change, and we'll expand on that in a second. But perhaps if I just give you a vignette, if you like, of a stock within this process that illustrates how we look at things. Now, a stock such as Centrica, which is a big holding for the trust. Those of you who are inveterate investors on the call will know that Centrica's had a slightly checkered past, by which I mean decade or so. But actually the last 3+ years, a huge amount has changed. And, you know, our job is to recognize change and really think this through, because if you think about what Centrica, the British gas operation, was dealing with, obviously it was dealing with an increasingly politicized, effectively gas and electricity was a political lightning rod. It was something that all political parties agreed on. And Centrica, through British Gas, had contracted long its gas. And this was a net negative, with Ofgem allowing the newer entrants to come in, not contract forward. And with the gas and electricity price falling, this was a relative disadvantage. So what did we see? We saw Centrica really, frankly, hemorrhage customers up until the recent past, where actually, as we all know, many of us on the call will have seen our energy provider change as the ranks of the energy providers have enormously concentrated. And, you know, Centrica, what it is looking to do is, if you like, become really, if you like, the sort of Tesco of the sector. Decent net promoter scores, underpinned by this cheap feedstock which it has. So the services, so the energy provision is healing. Then what they've also got is the services side. And if you think about what we need to do as a nation, and this speaks to investing responsibly and how ESG is integrated in our process. If you think about what we need to do as a nation, our housing stock is not in good shape from a thermal perspective compared to our European counterpart. So a lot needs to be invested. And if you think about how that's going to happen, well, the 6,500 British gas engineers, which I think if we did a straw poll of those listening, you would probably trust a British gas engineer. These are, if you like, people who are used to diagnosing problems. So it's not a huge leap of faith to think that they should actually, in due course, be doing heat pumps if appropriate and the like. So what you've got in Centrica is you've got a business where perception are changing, got a nice ESG angle, and you've got this long duration gas price for which actually we're going to see, which is very much in the money. We're going to see energy provision rocket even more up the corporate agenda, and Centrica will be a beneficiary of that. And when it comes to valuation, Centrica is, standout cheap. Those of you got access to earnings forecast, you'll see that historic earnings were of the order of 33 pence, falling this year to about in the low 20s. And what you've got is a free cash flow yield that is nigh on 20%, and you've got a business that is buying back just under 10% of its equity, and that's a real parable, if you like, for the UK equity market: cheap, changing, and buying back equity in big size. The next slide I would like to illustrate is just the sense of how much has changed for the UK, and I hope this slide resonates with a number of the listeners. And the genesis of this, if you like, is that I went to there are lots of these capital market day presentations which you can access on investor websites, and I went along to an M&S one back in October of last year, and they put together one of these collages, and you can access it on the M&S website and look at it. It's mid-October. I think it's called M&S Reshaped, and if you flick through that, what you will see is some pretty scary headlines. And if you think back to that period, it didn't feel good. I think one had a pretty nasty feeling in the sort of pit of one's stomach. Now roll forward to the current period, and this actually I put together about a month ago. If I frankly wanted to do it now, it would be even more positive. And really what I want to do is just illustrate that actually a lot has changed for the better in the UK. So our politics is more centrist. If you think about the election we have in 2024, our relationship with Europe, which is important in economic terms, is, if you like, healing to a degree. The electricity bills and gas bills, which were on the jugular of the consumer, are actually lessening, and that middle quote is from the Resolution Foundation. Consumer confidence, if you want to click on the GFT data and look at the quotes from there, it's pretty damn strong. And then really the fly in the ointment for balance is obviously our structure of mortgages, which are going to be a headwind, into 2024. But the balance is positive, and I think we should not forget that. If I give a flavour, and again in questions, I'm more than happy to expand on any of these. If I give you a flavour of some of the transactions we've done over the last 6 or so months, firstly on the right-hand side, you can see the sales. So right up there, a number of the long-term winners, the likes of Diageo, where we've decided to move out of. Diageo's been a one-way bet. You've seen effectively the discount rate help them, but more particularly, I think they have performed operationally very well, particularly in the States, where effectively you've seen a fantastic market share algorithm ever since the last down trading period in 2007 through 2009. But I just sense, and we just sense through our analysis, that we could be in for a slightly trickier period there in terms of the States. So we've sold that. In terms of the types of shares we've been buying, they scream strong market positions. I've talked about Centrica, but perhaps the best analogy is looking at Direct Line, where we sold last tail end of last year. What did we buy? Admiral. Those in terms of market positions, use of data, Admiral, it really is chalk and cheese. And those of you who've been through insurance renewals recently on the motor side will know that motor rates are doing a moonshot as those companies left in the industry are, if you like, scrabbling to get with the cost of claims. So we're seeing this big cyclical uptick. Market position, as I say, is critical. I mean, you just think about the strength of Premier Inn relative to the independents or the franchise operators, and that's being illustrated in the room rates that they're able to charge, or indeed Haleon. Haleon's a fantastic illustration. What that was we tend to eschew IPOs, but this is a demerger. And I really like demergers because you don't have quite the sort of array of sponsors, puffing the valuation. You effectively, through a demerger, the shares, if you like, settle at their to a degree their own level. And the joy of Haleon, which some of you all know, is in consumer health. So think things like Sensodyne or Centrate in Centrum in VMS. The joy of that one is that Unilever, you may have made a tilt at Haleon at roughly a 50 billion sterling price tag. And the EV of this one is still languishing at the 42 level, despite pretty strong trading and the like. So that gives you a flavour of the types of transactions which we've made. Again, in questions, happy to expand on any of those. But if we move on, what I and the team are looking to do is, if you like, layer the portfolio with multiple themes, recognizing that any point in time, it's not just one theme that's going to be driving the portfolio. And in this sort of slightly busy chart, I've endeavored to classify much of the portfolio into this theme. So for example, data analytics, those of you who may be customers of Dunelm, will know that this is a business that changed enormously over the last 3 years as they trying to drive frequency across their existing customer base. Or for example, where declining ore grades mean that actually the data you have on a mine's geology and how you process it, from the digger to all the way through to what actual ore you process, is critical. And Weir is a purveyor of that as a genuine mining technology business. Or indeed, I think this is quite an interesting theme. I do genuinely believe that many of the sort of written off incumbents, and I put M&S in that category, are actually now taking it to the competition. You can see that in the market share data, or indeed the banks, the likes of NatWest. And perhaps another one to emphasize is and really, I think it's a very good illustration of how ESG is no longer, or shouldn't be thought of as such a static thing. What it is it's if you like, a sort of living being. And I've illustrated this by saying that within that we do have a number of the defence companies which supply product on government to government contracts. So Thales is there, obviously post-Ukraine, defense in terms of defending democratic governments is palpably crucial. Another way of illustrating it is also through the banks. So if you think about what we need to do as a world to transition, we're going to need to spend approximately 7 times as much in, if you like, the developing world, to use that slightly ham-fisted epithet, as opposed to the developed world. And if we're going to do that, who is going to be ringmasters of that. Yes, there'll be various export bodies, but frankly, it is going to be the likes of Standard Chartered who are, if you like, going to be ringmasters of that. And so if you follow around this pie chart, you can see a number of the themes. Darwinism, massive theme for us. Supply chain resilience, obviously, totally, very, very high up agendas as the world fragments into different geopolitical systems. Right. Now, this is probably one of the driest slides in the deck, so I'm not going to spend long on this. But what I really want you to take away from this, just as a feel for the scale of positions that we take. And I think the other thing to illustrate from this slide is to show that the international piece, so non-UK listed stocks, which we do draw on from our top-notch global team. We do have positions there and have added value over time. So the current array of interesting stocks would include the likes of Novartis or CNHI, which is a competitor. It's Case New Holland, so a competitor to Deere in farming equipment, or Newmont in the largest gold miner in the world, KPN in telecoms. And what we look to do is occasionally buy non-UK listed stocks, and as I say, that has added value since taking on this prestigious mandate. Now, in terms of sort of drawing this to a close, before we go on to questions people may have, what we're looking to do is build a genuinely high conviction list of stocks, each of them as a result of strong fundamental valuation analysis. Within that, ESG is very much part of it. You don't segment ESG and then think about it afterwards. It is integral to our stock selection process. Why? Because if you're looking to buy, as we are, shares on a 3+ year view, you've got to be darn sure that actually companies are calibrating their profits in a way that works for all societal inputs. Think Tesco, one of the largest holdings. Obviously looking to outperform over 3-year periods. First proof point, tick in the box there. And obviously, as I've hopefully tried to illustrate, in the joy of, if you like, advancing this project as a team at the moment, is that actually the UK is at an unusually interesting juncture, each of a time, I think, to be investing in the UK. So if you take a step back, we've seen pension schemes broadly sell down. You just have to click on something like the Nest website and you can see how low the UK percentage in equities is, and that obviously had its, if you like, sort of clearing event with the LDI kerfuffle associated with the short-lived trust government in the autumn of last year. Wealth managers again have been on a long march as they look to move up the US weightings in lockstep with the MSCI. Now, who's the other side of that? So who's the other side of the selling? Well, it's a number of features. Firstly, it's corporate activity. You'll be aware of the long list there. And then you've got the slightly more shadowy, as we saw with Apollo moving out of a bid situation with Wood Group yesterday, I think it was. You've got private equity in there. And, more substantially in terms of quantum, you've got the fact that corporates are buying in proper size. So if we calibrate that, I talked about Centrica buying in up to 8% of its equity over the next sort of year or so. But if we look at the trust as a whole, 40% by value are, buying in decent amounts of their equity. So if I had to sort of take one side of the equation, who I'd like to be, I'd prefer to be with, if you like, the quasi-insiders, the corporates, and that is what we are seeing. And the other angle, which I think I'd ask those of you who are interested in investment trust to focus on is one of the big advantages of a trust is that we do have the ability to use gearing because it is permanent capital of sorts. And what the board and we have done over the last 18 months is taken advantage of the low interest rates to recalibrate and refinance our existing debentures. So we put in place 120 million of refinance debt, and the coupon of that has moved from a 7 handle down to 2.4%, and that has a weighted average tenor, so how long the debt is, of 25 years. So we've not only performed okay, but also strategically, we've done some hard yards in recalibrating the debt. So in terms of where we are, we're investing, as I've said, in what we think is a cheap equity market with occasional forays that are hugely well analysed and well thought out to non-UK listed stocks through our global team. So the UK equity market, in our view, is cheap. And if you take that premise through Edinburgh Investment Trust, you effectively get access to the UK equity market at a 8% discount, if you like. So the way I think about that is, if you like, there's a double discount available. Allied to that, what you also get is a reasonable running yield paid quarterly. So I will, at that point, hand it back for any questions that there may be.
Thanks very much, James. We do have quite a few questions that have already come in, but if you're in the audience, please do put your questions in the box on the right. Perhaps we could start with something that's quite topical. So there's been a lot of talk about the UK stock market losing its attractions as a place for businesses to list, with some high-profile companies moving elsewhere. Is this a serious long-term threat or issue? Do you think this is a problem, or is this a media story?
I think at the margin, we're obviously seeing a few companies move, the likes of CRH, which is, if you look at the asset array that it has, it tends to be mainly in the States. So there is a certain logic for it listing in the States. I think for most companies, though, actually, this is a very onerous thing to do. And so I think it will be at the margin. And I think we still have a very varied and attractive opportunity set to invest in. But I think there will be the odd headlines. But, I think one of the good headlines that perhaps hasn't got much mileage is that, Deutsche Bank decided to put 400 odd million on the table to buy Numis last week. There is a major European bank deciding that the UK stock market and those listed there have a long-term future. So, I think journalists love this one, but I just think below the surface, it's not all one way.
And your so mid and small caps have kind of been particularly out of favour really since the COVID correction. Do you think that there's scope for a recovery in this sector? It's typically where the most growth is generated in the UK. Would you look to invest more in this area? Do you have any limits on mid and small caps?
The focus of this really tends to be large and mid cap rather than small cap. But we do have, the likes of Greggs, which are, have demonstrated today are growing strongly, or the likes of, Dunelm, where, over the last pretty much 10 years, 80% of its growth, which has been pretty stellar over this period, has come from market share growth. So, I think what has happened is that people have written off, many an investor has written off large cap shares, and we're now at a point where valuation on large cap shares are, in my view, unusually interesting, and so it makes sense, to have, pretty punchy holdings in some of these large cap companies because they are cheap. I mean, if we look at the companies here on this portfolio snapshot, the likes of Tesco, market leader, 9% plus free cash flow yield, gently gaining market share. It is in a very, very strong position, and that valuation to me and the team seems very cheap.
And how do you balance your objectives of dividend growth with the total return investing, and perhaps kind of relating it to the current interest rate environment? Obviously, rates are significantly higher than they have been for some time. Does that change the opportunity and what you look for?
Yeah. So what we're really looking to do is ensure that the companies that we invest in have a level of dividend that is, if you like, not like a feudal tithe on the business. Because what we think is best is a company that is able to, have strong growth prospects, and then the dividend naturally flows off the cash flow statement. So, those of you who've followed a company like Dunelm, in that share price over the last sort of 3 or so years, which is an 11.50 share price, you've had 220 pence of dividend, a mix of dividends and specials, and yet gearing is very, very low. So we don't particularly, from each of our holdings, forecast or require a level of dividend. Obviously, at the total portfolio level, we and the board, and it's a key part of the board papers, ensure that the dividend flow coming off the portfolio is in line with our, if you like, our envelope of expectations. But what I would say to you is that if you can get the total return piece of the mandate correct, and if we look at this slide which we put up here, actually whether your dividend yield, dare I say it, is 3.9 or 4.2 is not quite as relevant as getting that total return piece correct. And also what I would say, and the board have been, I think, in my view, really on it here, we do ensure that the level of dividend that we pay out, actually is, has a strong relationship with the underlying dividend flow of the portfolio.
And we had a couple of questions about the move to Lion Trust. So what benefits have you gained from the move? And specifically, has there been any change to the ESG policy given Liontrust's focus on ESG? Has that impacted how you manage money?
Yeah, if we cover those in reverse order. So Liontrust, as we know, is and as I've experienced, a shrewd acquirer. And one of the ways it does that is when it is welcoming teams into the ambit, it actually leaves the investment processes intact. So the question on ESG is there isn't a dictate from on high, if you like, and we at Magedi have long been big, intelligent, I think, appliers of ESG characteristics. So we've long realized, if you like, that the sort of Milton Friedman view of, a company's responsibility being to profit maximize, and that's all that matters. If you like, the Philip Green type view of capitalism, that is all part of and has been part of history for a couple of decades, frankly. And we've espoused this view of a responsible capitalism, this view that actually capitalism needs to calibrate its profits in line with shareholder input. So yes, there will be, perhaps differences in our portfolio structure to the sustainable team in small areas, but each of those, obviously theirs are very well thought out and ours are very well thought out because, ESG, as I say, is integrated very much in the process. So that is ESG. In terms of advantages, being part of the Liontrust firm, stand out. And, in terms of thinking about the project we're involved in here, is obviously the Liontrust brand is a strong one. And as we look to, now that we've got to the 3-year anniversary, as we look to, if you like, advance the message on what we're doing, actually being part of Liontrust is a huge, huge advantage, which we look to capitalize on as we aspire, obviously, to move the discount in from its current level of 7%.
Turning back to the outlook for the UK, so the Bank of England quite dramatically upgraded its outlook for the UK economy in the last few weeks. But there's still perhaps a sense that inflation is more persistent in this country than elsewhere, at least a perception, certainly more persistent than the US. What do you feel is priced in the portfolio? So, I guess we spoke a bit about historic reasons for undervaluation, the Brexit referendum, perhaps some political turmoil. But looking at the numbers, are the share prices of your portfolio, are they pricing in a recession? So is this, if the Bank of England's right, is this a potential, is it an undervaluation opportunity?
Yeah, I think those of you who perhaps have access to, Bloomberg, you will see that something like the Citigroup Economic Surprise Index, which tracks data as it comes out and plots it relative to expectations, you'll see it's kind of done a moonshot. And, I'm absolutely not looking to critique, the Bank of England, but, along with other central banks, they found it difficult to navigate actual expectations. And what I'm really trying to say is actually, the outlook is a load better than people think. You just, click on GFK or think about what's going to happen in the fourth quarter of this year, our energy bills are going to go down. That takes a massive pressure off the jugular of the consumer, and it's going to happen at a point where the companies which we've invested in, which have quietly been, if you like, crunching the market shares against their competitors, they're going to really be able to sort of make hay against this environment, because much of competition, frankly, pretty knackered after this period in terms of, if you think about SMEs, it's been an intolerably complicated and difficult period for companies over this COVID period and now the reopening. And it's the larger, medium-sized companies with well-financed, consistent strategies that are really going to make hay. And that's what we've got. The portfolio is rammed full of these types of companies, which I think are going to, we're on the front foot, and they are going to make continued strategic gains. If you think about the likes of Whitbread, Dunelm, Greggs, these companies are pretty difficult to compete against. And with growth picking up, I think we're going to be in better shape. And, yes, you're right. Our inflation has been a bit more sticky, but if you think about the drivers of that, it has been weak sterling. What is sterling now relative to the dollar? It's kind of flat year on year. What is the oil price year on year? Is now down year on year. Obviously wages are stickier, but in the main, a number of the sort of, if you like, the pig in the python aspects of our inflation relative to the States are ameliorating. And markets are about, it's this difficult thing to convey, but I think markets, when you move from bad to a bit better, it can actually be quite an interesting phase, particularly when valuation is low and corporates are buying in, as I've said. So I think we are in much better shape as an equity market than people generally think.
And in terms of your portfolio, it's been a pretty volatile period. Has your turnover been higher than you would like or would expect? And what would your ideal long-term level of turnover be?
Yeah, so the ideal portfolio turnover from our perspective is approximately 30%, which essentially means that what I'm really saying is our average holding periods a bit more than 3 years. In the initial period of the mandate, it was a bit higher than that. More recently, it's been a bit lower, and I think what that reflects is that the companies, remember, within the team, we're seeing companies all the time titrating and analyzing results. What we're seeing is generally that company strategies are proceeding within the rough envelope of expectations or a bit better, and so there's no need, if you like, or requirement to make portfolio turnover. So I would say sort of relatively low turnover, and that's good because turnover, as we know, has a cost.
And there's a last call for questions. If there's something you're burning to ask, please do so now. We had a question about the international holdings, if you have a limit on those, and what would lead you to increase your holdings there, or vice versa.
Yeah, so we have broad limit that the combo of cash and international holdings can't be more than 20%. Over the life of our management of the trust, we have had between about 7 and 14% in non-UK listed stocks. Part of the reason we're at a relatively low ebb at the moment is just this feeling that sterling, and it's been true of the last 6 or so months, we've had a relatively low ebb in international stocks. Why? Because, sterling, if you think about it, had been a very low ebb, 106 against the dollar. It's now back to sort of the 124 to 126 zone. But actually, if you think about it from a purchasing power parity basis, and those of you who've been to the States recently will know, actually, the purchasing power parity basis for sterling is more the sort of 140 level. So there is quite a high hurdle for investing in non-UK listed stocks, particularly when actually the outlook for the UK is brightening, and arguably the outlook for the US, and this might sound a bit controversial, but arguably the outlook for the US is not perfect. They've got a banking problem, which is going to lead to a credit crunch. They've got probably a quite tricky election to get through as well. And all that is layered in with valuation that is pretty high. So, where we do have international stocks, it tends to be in across the channel in Europe. So the likes of Thales in defence or KPN, for example.
Fantastic. Well, James, thanks very much for your presentation and for taking the time to answer all those questions. And thank you to the audience for your attendance. And I would just like to, before we go, remind you that tomorrow we will be hearing from BBGI Global Infrastructure as we continue this income theme event. But James, thanks once again for your presentation, and have a great afternoon.
Well, thank you, and thanks to Kepler for hosting.
Goodbye.